A lot to process this month. The Fed's new stance on inflation, the wait for congressional stimulus we were just discussing, the rising COVID cases, an election. How are you parsing through all the data that's coming in?
Well, you have to set up your risk matrix when you're thinking about the economy and the election right now. Lots of concern about political risks spilling over into financial markets. I think you're seeing a little bit of that this morning. Mostly, I think what we're seeing here is, the public health situation has improved somewhat. We had a late summer lull in infections, but we're starting to see them rise again. The big movement this morning, I think, is caused by what's happening in the UK, where the R, or reproduction rate, is now approaching 1.7. Nicole, that's akin to a nuclear fire. I'm not really surprised by the massive sell-off we saw around Europe, the UK, and into the US trading session this morning. When I'm thinking about the economy, look, we mentioned this before, no vaccine, no meaningful recovery. We've bounced back from the lows of March and April, but we're only operating around 80% capacity. So when I'm thinking about the economy, I'm thinking that, okay, we've reopened partially, but all the low-hanging fruit has been picked. All the easy things have been done. Now the hard part begins. And that's one of the reasons why you're seeing that risk aversion across asset classes this morning.
Yeah, there is risk aversion across asset classes. And, the folks who tried to go out on a limb here and go for the small caps, the Russell, for example, down 4%. The folks that were trying to chase dividends in energy stocks, for example, a name like Halliburton's down 10%. Energy's the worst. We heard from the Fed, and they gave us an outlook that seemed somewhat positive, right? Some improving unemployment numbers, GDP improving. We've had an incredible housing market. What is your outlook for the next 6 to 12 months? And the reason I ask this is because then people can interpret that and make some decisions with their money. How do you think the economy does in the next 6 to 12 months? Same, a little better, or a lot worse?
Well, the GDP report, we're going to see north of 30% growth in the third quarter, and then we're going to slow down to about 5% growth. The problem is we're still going to be well below the full utilization of capacity to produce and consume in the United States, probably until mid-decade, which is why traders responded negatively to that forward-looking rate guidance that the Fed put in front of the market last week. Federal funds rate's going to remain at zero until 2025. If I look at my forward curve metrics, markets fully price that in. And I think that's one reason why you're seeing the response you are today. Second is, if there is a resurgence in the UK, Bank of England's going to move towards, if you see a resurgence of the pandemic, or it intensifies and it results in further lockdowns, Bank of England has signaled that they may move to negative interest rates. One of the reasons why the financial sector and banks are getting hammered today.
Yeah, that's interesting that you make an interesting point with that, because we hadn't discussed that part of it. We've talked about lockdowns. We've talked about some reports of some shady lending, but negative interest rates is another topic. Tell me about sectors and groups. And when we see the turnaround, it's been evident to us some of the names that have done better because that's where the demand is, right? So you have consumer sentiment. We're seeing what the consumers want, right? They're using Zoom video. They're on their Peloton. They're using DocuSign. All of those stocks today, Joe Brusuelas, happen to be higher. Well, everything's selling off. Those three are still in the green. So do you have areas, sectors, something that you think might do better, or what might do terribly?
Well, because I don't dispense stock advice, I look at the economy. I would say you want to have broad exposure to the Zoom economy. Zoom, Peloton, anything TMT, technology, media, telecommunications, life sciences. We've said this before, pandemic's not going to stop the rollout of 5G, right? In fact, if we get a big infrastructure bill next year, I would think those who have exposure to construction, residential investment, anything that has to do with the integration of 5G into our entire railroad and port networks, you're going to do very well, despite despite what's happening today and the sell-off over the past 3 weeks, which I think has more to do with the correction to the run-up in August, which I don't find anybody who believed in that run-up. We all may have enjoyed it, but we're experiencing the payback now.
What do you think about unemployment? Where does that go?
All right, so by the end of the year, I think unemployment is going to be around 7.8, 7.9%. Okay, that's much better than the official 14.7% high that we experienced in the pandemic. But I have to tell you, we had a depression-like shock, but we avoided a catastrophe because both fiscal and monetary policy moved so quickly that we were able to cushion the fall of the economy. But there has been a significant long-term damage to the labor market. Okay, we're going to go with the official unemployment rate. That's fine. But so many people have fallen off the rolls. They've exhausted their 26 weeks of unemployment. The real unemployment rate, and Mr. Powell hinted at this during his presser, is about 3% higher. So it's 8.4% now. That means it's around 11.5%. The real unemployment and underemployment rate sitting around 14, well, that's closer to 17. There's 30 million people on some form of unemployment insurance.
Right.
Those are depression-like numbers.
Yeah.
So you're only going to see so much of a bounce back or rebound in the consumer retail sector. At a certain point, that levels off.
Well, that's what I want to ask you. I'm out of time, but I got to pick your brain on retail and autos and what folks are thinking. Do they have a job? Do they not have a job? How they will spend, how they will save. These are the things that you watch. And that could translate into retail and auto sales and things like that. Final thought on the consumer.
Well, consumers are going to be constrained for some time. Again, the low-hanging fruit's been picked. Everybody's bought a new car, replaced the old stock. If you want to get a mortgage, you can get one 30-year fixed at 2.87%. Fantastic time if your job's secure. But the burden of the adjustment's been on renters, those who worked in leisure, hospitality, 1 out of every 9 workers. We're going to have a bifurcated economy for some time.